In this video, we're going to go over the Chapter 16 examples for Principles of Accounting 2. So in Chapter 16, we talk about various cost classifications for items, and your homework will have you classify various items. So when we're classifying items, one of the things we want to determine first is if it's a product or a period item. Once we've determined if it's a product or a period item, then we can move to the other classifications. The other classifications are going to happen only for product-related items. So we're going to look at each cost item individually. The first one on our list is bicycle tires. Bicycle tires are used in production for bikes. That makes them a product. So we're going to determine then what kind of the other classifications that they have. Well, they're considered a direct material because they can be directly traced to the manufacturer of a bicycle. So we have a product and a direct material. Then if it's fixed or variable. If it's fixed, that means the item stays the same regardless of how many we produce. If it's variable, then the cost changes directly in relation with the number that we make. So an example of a bike, we need 2 tires for each bike. If we make 1 bike, we need 2 tires. If we make 2 bikes, we need 4 tires. That makes a bicycle tire a variable cost. Then the last thing we're going to look at is whether it's a prime or conversion cost. If you remember from the slides for class, prime costs are direct materials and direct labor. Conversion costs are overhead. Overhead and direct labor. Overhead is our indirect cost. Everything that becomes an indirect cost goes over into overhead, which ends up in conversion. We've already determined that bicycle tires are a direct material, which makes them a prime cost. Next, we have assembly worker wages. This is our production assembly. So just by wording, looking at the words, we can determine that production assembly is a product cost. This is a direct labor cost. So it's a direct cost with our direct labor. We saw from our slides in the chapter that direct labor is both a prime and a conversion cost. Now, trying to decide whether direct labor is fixed or variable, this is where we want to look at the words. So the word wages means hourly wage, which is a variable cost. Where down here, the word salary means a fixed yearly salary. So salary indicates a fixed cost and wages indicates a variable cost. Advertising. As we saw from the Chapter 16 lecture, all selling and administrative expenses are considered period costs and not product costs. Advertising is a selling and administrative expense, so advertising is a period cost. The production manager's salary. This clue is given in our word, production. So it's related to our products. Is it a direct or an indirect cost? In order for a cost to be a direct cost, if you remember from class lecture, it has to be able to be directly related to the exact product. That means that we would have to be able to tie every minute of this manager's time to an individual product or products. We can't do that, so that is an indirect cost. Indirect costs all end up in overhead. Overhead is a conversion cost. And salary is a fixed cost. Next, we have office depreciation. When we're trying to decide whether something is a product or a period cost, like in the case of depreciation, would ask, do we need that to make the product? So, do we need an office building in the manufacture of a product? No, the office building is not related to the manufacture of a product, so office depreciation is a period cost. However, the next cost item, factory depreciation is related to our production. So that is a product cost. Factory depreciation is an indirect cost. It gets lumped into that overhead pool. We've already said before, anything in that overhead pool is a conversion cost. And factory depreciation is considered a fixed cost. Our next item is sales commissions. Remember when we set up here at advertising, anything that is a selling expense is a period cost. Sales commissions are a selling expense, so they are a period cost. Oil and grease applied to gear chains, an example of bicycle production. That's a product cost. We need that as part of our production. Whether or not it's a direct or an indirect cost, we talked about that in the lecture videos also. It is an indirect cost that ends up in overhead. Overhead is a conversion cost. This is a variable cost because the amount of oil and grease we use changes in direct relation to the amount of items that we produce. Next, we're going to make a schedule of cost of goods manufactured. So we have this information here. We have beginning and ending information for our three types of inventory. Then we have other information about what we used throughout the year. So we start with this work in process for January 1st. So our work in process inventory for January 1st is 12,000. Next, we want our manufacturing costs assigned to production. So we have direct materials used, which you can see up here, is $210,000. Our direct labor costs are $120,000, and our overhead costs are $192,000. We add those three items together, and that gives us our total manufacturing costs for the year, $522,000. Then we want to add those manufacturing costs to our beginning work in process to give us the total cost from the year. The next step in the schedule of cost of goods manufactured is subtracting our ending work in process inventory. So we'll come back up here and we see that our ending work in process inventory is 8,000. So we're going to subtract 8,000, and that gives us our total cost of goods manufactured for the period, $526,000. That's our schedule of cost of goods manufactured. The next question we have is, assume that the company manufactured 20,000 units during the year. What is the average cost per unit of manufacturing the product? Our total costs were $526,000. So to get the average cost, we are going to take $526,000 and divide it by the number of units we made, 20,000. So our average cost per unit is $26.30. In this example, we're going to go beyond the schedule of cost of goods manufactured and calculate some other numbers. But we have to start with the schedule of cost of goods manufactured because we need the information from that to do anything else. So we're going to run through this just like we did on the other slide. We start with our beginning of the year work in process, $3,000. And then we add the manufacturing costs assigned. Now we have a lot more information about our manufacturing costs, so we need to make sure we're picking the right numbers. For example, we have purchases of direct materials and direct materials used. On the schedule of cost of goods manufacturing, we want the direct materials used. So 333,600. Then we're going to add our direct labor for production, 180,000. And then last, our manufacturing overhead, 288,000. Just like we did before, we add those together to get our total manufacturing costs. We add our total manufacturing costs to our beginning work in process to get our total cost of goods in process during the year. Then we subtract our ending work in process inventory of 4,700 on the chart, and that gives us our cost of goods manufactured for the year of 799,900. That's part one. Number two says compute the average cost per unit. We have total cost of 799,900. And up here in our information, it says during the year we manufactured 61,000 units and sold 62,100. So to determine the average cost, we take our total cost, 799,900, and divide by our 61,000 products. Gives us an average cost of $13.11. Now we want to talk about the cost of goods sold. And we're going to assume that the company uses FIFO. So that means first in, first out. We sold, it tells us, 62,100 items. We have an inventory, 3,000 units at $13 a unit. And we just manufactured 61,000 units at $13.11. So of that 62,000, we sold 3,000 at $13. Yep. So 3,000 times 13. Then we would take 62,100 minus 3,000, leaving us with 59,000 units, 59,100 units at the average cost that we calculated up here, $13.11. So that tells us our cost of goods sold is $813,985. And 8 cents, which you're probably going to round to a whole number and connect. The final part of this problem is computing the amount of any materials, work in progress, and finished goods inventory. The work in progress is already calculated for us. That's $4,700. So let's look at calculating the amount of ending materials and the end of finished goods inventory. So for materials, We're going to start with beginning materials. Move that over. Our beginning materials at the beginning of the year were $12,800. We add purchases. So we have here that we purchased in direct materials $332,000. We subtract materials used. So here are materials used, $333,600. That gives us our ending direct materials. So we have $11,200 at the end of the year for direct materials. To determine our ending finished goods, we do a very similar thing. We start with our beginning finished goods inventory, which is $39,000. We add the amount manufactured, or a cost of goods manufactured. So we have our cost of finished goods manufactured here, $799,900. We subtract cost of goods sold. We calculated our cost of goods sold here. We're not going to include the cents unless Connect asks you to go out a certain amount of decimal points. Connect will tell you if they want you to include cents. So we subtract our cost of goods sold. That gives us our ending finished goods inventory. $24,915. The other way to calculate finished goods inventory is over here when our cost of goods sold, we calculated that of those 61,000 units that we manufactured, we sold 59,100 of them. So if we take 61,000 minus 59,100, that leaves us with 1,900 items in our finished goods. We take that 1,900 times the average cost we calculated earlier, and we get $24,915. If we wanted to know what the total inventory calculated at the end of the balance sheet, we would add our materials inventory, our work in process inventory, and our finished